Exchange traded funds in India have grown tremendously in the last 7 to 10 years. Today, you can easily build a low-cost, globally diversified portfolio with just ETFs. A lot of investors make avoidable mistakes when they're buying and selling ETFs. So in this video, I'm going to talk about the basic mistakes that a lot of investors make and how to deal with them. The first thing you should remember is don't buy and sell ETFs right at the market open. The volumes of ETFs tend to be low for the first 15 to 30 minutes of market opening. Because of this illiquidity, the prices tend to move sharply and you may end up getting a bad price. Give it 30 to 40 minutes after the market opens and then you can place your buy and sell orders. So the takeaway is avoid buying and selling ETFs right at the market opening. Second, make sure that you always use limit orders. Even though ETFs have grown, most of them have very low volumes and most of the volumes are also concentrated in a small set of popular ETFs, as you can see from this chart. If you place a market order, the order may be executed at prices far away from the last traded price. Take a look at this ETF. It's illiquid and you can see that only about 160 units have traded so far. If you place an order for 10 units, your prices would have been executed from 704 to 719 rupees, even though the LTP is just 691. So this is a difference of 4% and this is called as impact cost. ETFs are low cost and this impact cost defeats the purpose of low cost ETFs. So always use limit orders. To put it another way, if you place a market order and the impact cost is high, you lose the money due to the difference between the bid and ask prices. So placing a market order defeats the purpose of investing in ETFs since the reason why you invest in ETFs is the low cost advantage. As I mentioned earlier, not all ETFs trade regularly. So if you're investing in an ETF, don't just check the volumes of that particular day, but make sure you check the historical volumes as well. You can quickly see this on kite charts. So the takeaway is always use limit orders to reduce the impact cost and stick to ETFs that have good volumes over a long period of time. And you can quickly check this on kite charts. The third thing is trade carefully during volatile markets. During volatile market phases, ETFs can often trade at large premiums and discounts for a variety of reasons. For example, you can check the chart which shows how Nifty ETFs performed during COVID. As you can see, there are large differences compared to Nifty, which is illustrated by the black line. So when you buy and sell ETFs, make sure the price of the ETF is as close as possible to its INAV. INAV is known as indicative net asset value. It's a measure of the intraday net asset value of the ETF. You can check INAVs directly on Kite, but there are times when the INAV may be incorrect due to delayed updates. So make sure you double check the INAV on the respective AMC websites. So please remember, make sure the price of the ETF is as close to the INAV as possible when you're buying and selling ETFs. You can also create SIPs on ETFs. If you invest in ETFs regularly, you can create an SIP just like you do with mutual funds. You can also create an e-mandate to make sure that the funds are automatically debited every month. The funds are debited from your trading account. So to know how to create an SIP, check out the link in the description below. The takeaway is make sure you take advantage of SIPs on ETFs. Trading symbols of ETFs can be confusing. You can check out a list of all ETF symbols. On Trading Q&A, we have added the link in the description below.